the issue and the challenge we sort of give to that is what that really just represents is gross demand, that there is some sort of demand that exists in the ecosystem, your customer sets that want your product. Now that could be in the form of APIs, that could be in the form of a product that you deliver that's akin to a service. And a lot of what we wanted to be able to do, given that we had come from this background of building our products and quantifying product market fit.
Welcome to Prime Venture Partners Podcast, a podcast for entrepreneurs looking to build and grow their startups. Learn about uncommon strategies and common traps from makers and doers of startup ecosystem.
Welcome to the Prime Venture Partners Podcast. Today I have with me two special guests, Arjun Sethi and Jake Ellowitz from Tribe Capital. We've had the pleasure of working with Arjun and Jake over many years, first at Social Capital and now at Tribe. Welcome to the show, guys.
Thanks for having us, Amit.
Thanks.
All right, so we're doing this for the first time with two guests, so I think you'll get our voices in a few minutes here. But let's get started with Arjun. Can you talk a little bit about both your journey and the purpose of Tribe and what you guys do there?
Sure. My journey is pretty typical, founder turned VC, but the way in which it happened was maybe starting around 2006, 2007 timeframe. Came back to the Valley and started building companies in the social gaming ecosystem, in the mobile gaming ecosystem. The first company was called Ellowitz. What we had built was applications that were on Facebook and then applications eventually on mobile devices like iOS and Android. So we grew very quickly, grew from 0 to a couple 100 million monthly active uniques. I think at our peak, we're close to 300 million monthly active uniques across all devices. And I think there was a point at which I think Facebook had said that there was about 1 million applications on their ecosystem, and about 999,000 of those applications was us at Ellowitz. So we grew very quickly. And what that really meant in order to stay successful and grow from applications to games to building out your products that had sustainability was that we had to leverage our data, our infrastructure, our analytics, our teams to build better product, right? So at a faster and faster feedback loop. And this was a time when people started using the term growth hacking, growth ninjas, all these sort of marketing terms where you would, again, leverage data to build better products, but also leverage data to do better marketing. Many of people have called it going from Mad Men to Moneyball, right? Like to sort of that thought process. And that was the time frame of when I was building my companies and managing a lot of these folks, figuring out how product managers, data scientists, data analysts, data engineering all work together. We were part of the first customers to use AWS and some of the first customers that started building not just our own internal analytic systems, but using third-party data and analyses that were out top of Amazon. So, sort of fast forwarding my time from Ellowitz, sold that company to a company called Nexon, which went public in Japan, but based in Korea, went IPO around 10 billion. We ran their whole playbook around publishing. And remember, in the mobile gaming ecosystem or in the social gaming ecosystem, leveraging your data and your marketing was really important. And the reason was that you would be spending, millions of dollars in marketing, if not on a monthly basis, in some cases for certain types of titles, you'd be doing that on a daily basis. And I think, as we were growing up, it was kind of scary when you would spend $9 million a day in marketing. So this became a DNA within the company, and it's why we were acquired and what we were well known for, at least within the Silicon Valley ecosystem, for growth, leveraging data and leveraging your growth capabilities and your product capabilities by leveraging this. So what that really meant, though, was that you'd have to have frameworks to think about how to build your products from scratch, frameworks around how to think about marketing your products from scratch, and understanding what the definition of growth was. And I know we'll talk about that a little bit more today, but that was sort of the beginning of my career. And then I replicated a lot of that brand value in my angel investing over the course of the year, over the last, I want to say 10 to 15 years, by coming in and understanding what it takes to sort of think about growth and think about how to build out your teams and structure that. And that was with a company called MessageMe, sold that to Yahoo. I ran the growth and data science team there, basically leveraging the exact same blueprint that I had created in my past companies. And then fast forward into Social Capital and Tribe. A lot of the work that not just myself, but the rest of my team, Jake here included, Jonathan, who used to run the data science team at Facebook, all of us came from a collection of leveraging data to build better product, make better decisions, build out abstract layers of thought into something that could be useful towards either investment decision or managing a portfolio. So a lot of it was taking these pieces that we had used to build and operate human capital and products into investment and financial capital, and how do we deploy that. And if I fast forward the journey to what we do at Tribe today, a lot of what we talk about is the value exchange of us being a part of your cap table and having the Uber or the Slack or the Airbnb and Facebook data science team at the helm with you.
Wonderful, Arjun. Very, very helpful. Jake, you want to talk a little bit about just what specifically you do at Tribe before we get into some of the data magic that we're going to talk on this podcast?
Yeah, totally. So at Tribe, I'd say I'm kind of split in a few ways. There's on one side, understanding businesses working with our portfolio and these types of things through the frame, often aided through frameworks using data analysis, digging real deep into raw metrics and things like that. And on the other half is building out kind of our capability, coming up with some more quantitative frameworks, some of the stuff we use in-house, and also building out a lot of our infrastructure. How do we make ourselves smarter over time? I think ultimately the question I'm trying to answer is how do we leverage the ability to compound everything we've seen into every next thing we see, and what does that look like in venture? So I think those are kind of like the high level of kind of where my mind is, and obviously leaning very heavily on my partners at Tribe with great experience and a lot of insight in terms of how venture around the world works, and we're trying to kind of build that into a super venture brain, if you want. And so that's kind of one of the big things I'm excited about.
Yeah, Jake is a little modest here, but he's essentially our resident CTO. I mean, I think what's important to note is the way we structure Tribe is more akin to a company. And, we think about building systems and software and delivering capital and aligning with our founders and our management team. And so what that means is that we build products, we run them the same way startup companies do, with a Scrum team, stand-ups, and thinking about, what type of artifacts and products that we can deliver beyond just capital to the investments and the companies that we're representing.
Great, guys. So let's dive right into it. Product market fit, it's a term that's been around for many years, over a decade perhaps, right? And it hasn't really been quantified. People will often tell you, you'll know it when you have it, right? Or Ben Horowitz had said it in his book that when the phone's ringing off the hook, right, then you got product market fit, etc. But on the, if you go to mature companies or later stage companies, even in the public markets, there is the gap statement, right? So can you guys talk about a little bit about, what is it to quantify product market fit, and in particular the 8-ball framework or any of the other frameworks that you have, and how should one go about quantifying it, both from an investing perspective and a company building perspective?
Yeah, absolutely. And I'll let Jake dig into the pieces, but I think what's really important to note for any company is, when you look at the qualitative examples of the investors that are out there in the ecosystem saying, when you have X, you have product market fit. The issue and the challenge we sort of give to that is what that really just represents is gross demand, that there is some sort of demand that exists in the ecosystem, your customer sets that want your product. Now that could be in the form of APIs, that could be in the form of a product that you deliver that's, akin to a service. And a lot of what we wanted to be able to do, given that we had come from this background of building our products and quantifying product market fit, the reason you wanted to do, a basic foundation of understanding what it means to quantify product market fit was to understand what the growth and demand signals could look like in the future, and how do you think about use of proceeds? How do you build a company for growth? And growth can happen in many, many different ways. But in order to understand how growth can happen in many different ways, and how do you augment that, you have to understand what your underlying foundation looks like and what that means. And so we had these family of concepts, that we'll go through in a second. And when we put all of those family of concepts together, we called that the Magic 8-Ball. It's an artifact that we deliver back to the founders and the entrepreneurs and the management teams, or LPs, or other investors around the table, board members, where they're able to hold an artifact that is ground truth around the past and now the present.
Yeah, and just to add a little to that, fundamentally what we're trying to understand are what are the levers of a business. if they were to change pricing, if they were to change channels or change marketing tactics, if they were to heavily subsidize something or pump a bunch of capital into something, and how can that all change? So, I think those are kind of like one piece is like, what are the levers of a business? How can we understand those? And then there's the other stage of how can you understand it early? Because you're saying there are lots of examples of, okay, after product market fit, you can really see it, but how do you see the signals before it's screaming and obvious? I think is one of the tricky, nuanced parts.
Hey, Jake, let's drill down into it, right? There are three components I could figure out from your website. One is just looking at growth accounting. Another one is really understanding cohorts. I have lots of questions for you on that. And then distribution of product market fit. Can you elaborate a little bit about those? Obviously, we won't have time to cover all the metrics, but if you can give our listeners some sense of what these various things are and some numbers around those.
Yeah, so these are just different ways of understanding the way that the business is evolving and growing. Growth accounting, so I'll talk about them one at a time, then maybe we can get into more details. But growth accounting first seeks to just understand the top line. Is there growth? What does the growth look like? What does the acceleration look like? Combined with decomposing the nature of the growth into different types of categories, such as new versus churn versus resurrected. And what that does is it gives you kind of one flavor of what is contributing to the growth. Just a quick example is one way you could have growth is lots of new users and lots of churn users. Another way is not a lot of new users and very little churn and revenue expansion maybe. So, it's not like one is better than the other. You might see the former in a D2C company, and now you're asking different questions than the latter, which is a more typical B2B SaaS company. But that's just kind of like, it gives you one flavor of how the growth looks. So cohorts, I think cohorts, this is no secret, right? Many people look at cohorts. This is not just us, right? But I'll talk about kind of how some of the ways we think about it. To us, cohorts is probably one of the most important things to look at in general for many businesses. It's not like it is the one to look at, but what it does tell you is the evolution of a customer and how the evolution of the customer looks as the business evolves. For example, if you add tons of users, are they remaining engaged, right? If so, maybe the market's deep. One thing is there seasonality? And is that something that you should be very mindful of because you're looking at a top or a bottom there? And then, there's all sorts of other things you might imagine that might show up there, like COVID, right? That will show up on a cohort analysis. But then there's also other things that you might be curious about in terms of leading indicators of acceleration. I think this is really one of the places where you might start to see it, where in particular, if cohorts are strengthening as there's more value extraction, or cohorts are strengthening as there's more scale. Those are really some of the holy grails. In particular, like LTV, so total value, maybe you would imagine over the life of a cohort. If that increases over time and it's so-called super linear, then which is pretty rare, unless there's sometimes it's a good thing and sometimes it's signs of other things. But those are just some things to look at where you say, this is a thing. I should drill into that. I should understand what this lever is. And the final one is the distribution. There's a few ways to think about distributions. This one is mostly for us to look for breadth. What is the variety of users and how do they compare to each other? One case is things are concentrated. If one or two customers account for most of your business, what does that mean? If you're an enterprise company and you're early on, what does that mean? If you're not an enterprise company, when you see that, so I think there's like lots of questions that you can kind of derive from each one of these. You can imagine you would layer these on over a business, look at the business model, look at kind of the evolution of what they're doing, the new markets they're entering, and then start to ask questions, looking at how the engagement's unfolding. So that's just kind of like the high level of how we normally would engage with these types of metrics through this framework.
Wonderful. Let me drill down a little bit into it, Jake. And let me pick particularly on the cohorts, since I think they're quite misunderstood. And for that matter, the distribution, as you described it, of the cohort itself. Often people kind of confuse it and look at it as the aggregate whole, or perhaps averages around cohorts and so forth, right? Really don't sort of break it up a little bit. And like the example that you just cited, or at least the notion of even in the distribution, think about customer concentration. Think about, the various segments inside the cohort. It's not just everyone who came in the month of April 2020. Can you talk a little bit about that? And then we'll come to the growth bit in a second.
Yeah, for sure. Actually, a good example of this is Shiprocket, which is a recent investment of ours. And the interesting thing is what you're alluding to is something of the sort of a Simpson paradox that you might see in a business, or like without referencing statistics here, the sum is sometimes different than the parts. So one thing that can be meaningful is to break up and say, okay, well, what are the different types of customers? In Shiprocket's case, it might be customers shipping just a few shipments a month, and then customers shipping many, and then maybe customers shipping a ton, like enterprises. And so, you would look at how those different customers are engaging, and actually each one tells you a pretty different story in the case of Shiprocket, and actually each one's evolving differently over time. The smaller user segment, you actually see they're actually not a big contributor right now, but they're growing really, really rapidly, and they're engaging more over time. And so, in a way that was special as compared to many of the other segments. And then you could start to ask questions, what's happening there? And you wouldn't actually see that type of engagement if you didn't dig in and pry it apart. And I think that you're really right, that the cohort analysis is not a cohort analysis. There's lots of different cohort analysis that you can do, and they can all tell you different things. And it's really important at this point. It's like, I think understanding the business, understanding the customers, understanding what's happening in the market will give you hints in terms of how to pry it apart. It's this feedback loop of asking questions and going deeper with these different types of cuts that you can think about. And you can definitely veer off of this framework, but this is a good starting point.
Yeah, to echo Jake's thoughts and his relation to Simpson paradox, what it basically really means, for more in layman's terms, is instead of thinking about two topics, I think this was a really famous one here at UC Berkeley, where they just kind of looked at men versus women, and were women or men biased against, right? And so they came up with this conclusion that women were biased against. But then if you take a look at the segmentation and the cohorts for different groups within men and women, and sort of look at them similar to how we look at a company and say, it's not just revenue, it is revenue within a certain, it's not just revenue, it could be engagement, it could be usage. And then how do you overlook that all together? You can start seeing different aspects of what Jake had mentioned as different parts, how they all add up to the sum, and when is there different types of directions that the company is going in. And so what he meant with Shiprocket is that, there are, people that send 0 to 10 shipments a month. There are folks that send 10 to 100, and then there are folks that send 100 to 1,000, 1,000 above. And when you start segmenting them, you can see that there's different behavior sets, and in understanding the businesses and what levers may or may not be pushed. And so when you kind of take a step back and say, okay, great, you're starting to understand usage, engagement, revenue, how they all behave together versus separately, then you can start thinking about what are the types of products that you build, either those being feature sets or being an overall whole or value prop or a superset of the product. And that's a lot of what comes from just leveraging data to build a better product. And that's where we come from.
Wonderful. I think, Jake, you also mentioned earlier on, right, in the podcast, this notion of, your packaging, pricing. Arjun just said, your features and your product strategy, everything could ensue from that, right? So in practical terms, have you guys, as you've met and interacted with lots of entrepreneurs, you've done lots of 8 balls in both Social Capital and Tribe. Have you seen folks kind of think about this consciously, or entrepreneurs tend to be much more intuitive and they're sort of just like, all growth is good growth, right? Let's go, right? Or maybe perhaps they're sitting at the higher level saying, well, if MRR is growing, MAUs are growing, engagement is growing, let's rock, right? Like, we'll figure it out later.
Yeah, I mean, I think part of what you see from a lot of founders is, as long as, this is when I go back to growth and just gross demand, right? Like, when people say that I have phones ringing off the hook, that's gross demand. The problem with that is you don't know how that demand is coming in. You don't know which parts are strong, which ones are weak, which one's churning out or not. And that's why we have all these concepts. And so at a high level, I think what's really important is that we probably skipped is, when we do this work, the reason we're able to do this work is we're not asking a founder for like a deck in a data room and tell us like what's the number that's going up and to the right, the demand metrics. We're asking them for a raw pile of data. Similar to when you look at a financial ledger and you get a raw pile of data, you're starting to build out the family of concepts. Our quantitative approach to product market fit, all of these frameworks come from us building a bottom-up view of the company ourselves. And that artifact is called the 8-ball. And when you do that, then you're able to start asking these questions in the first place with the founder. Hey, so now we're able to see how your customers are interacting with the product at this segment or at this stage or at this region, et cetera, et cetera. Obviously, more the better. But we see that for a lot of companies at the early stage, even at the Series Seed and Series A, where you're seeing a lot of these leading indicators of what type of product that they have. What that really allows you to do is start having a conversation. Some of the founders might not be really attuned to their market because they come from that market. So they kind of have an idea where they want to go. And so the data substantiates the direction they want to go and the roadmap that they want to build. But a lot of times what happens, and actually this is the case in ShipRocket, the first thing the investors had said were, we need to move up to mid-market and to enterprise and then, super enterprise. And then what you'd see from the data is that they were just so strong in light and small to medium shippers, and mid-market was starting to emerge, that the largest concentration of their growth is coming from that segment, and they're the ones that are using it the most. And it's counterintuitive. It's counterintuitive for a company that is shipping products from small, very, very small to medium merchants to an end consumer. And, they could have completely changed their roadmap to focus on mid-market and enterprise because that's what the market was dictating.
Arjun, I have a question for you and perhaps Jake as well, right? I think you guys said that every customer segment tells a different story. Now, oftentimes, as VCs, we tend to say, focus on one thing, like don't do SMB and mid-market and enterprise and blah, blah, blah. How do you reconcile that, right? Because even with the ShipRocket example, because the lightweight shipper will have a different set of requirements and needs than an organizational cadence and, a wavelength that is required to serve them as the large enterprise doing, 10,000 orders a day.
Yeah, I would think that you can be focusing and still get different engagement from different customer segments. And there's a bit of when you think about maybe your product development, you might have, something that a feature, for example, and you roll it out to all your customers, and then you find engagement and who's engaging and how are they all engaging. So you can actually see focus on the product side and emerging on the engagement side, all sorts of different things. And if you can understand that, then you can continually iterate and make your product better. But it's also maybe, maybe there's just a few different types of use cases and it's just worth understanding them.
What I'd add to that is, we have 3 examples in our portfolio and past portfolio, right? So a company called Slack, Carta, and Bolt. And all 3 of them, right, you have to think about the life cycle of product market fit and where they were at that time. And ShipRocket follows this kind of same trajectory, where they're starting to create something special. They all started with a segment that was highly engaged, growing very quickly. And they started deciding if they wanted to move up market or down market or do all of them at the same time. Now, as you know, you can't do everything at the same time, especially when you're a team of 5, then moving to 10 and then doubling sort of, let's say, if you're growing healthily every 3 to 6 months. And so, there isn't actually a right or wrong answer here. It's more about like, how do you prioritize your time and what you need to build in your product. But for those 4 examples, they all started off small to medium style businesses, in some cases, minuscule businesses, to create a bottoms up growth pattern. And that's how they grew. And then some went to a direction that was full enterprise. Like an example like Carta, they went full enterprise and then they came down to mid-market instead of, moving up stack to stack, small to medium, mid-market, then enterprise. And then they build multiple products for all of them 2 to 3 years later. And then for Bolt, same thing. What they actually did is they built small to medium. Then they actually stopped building for small to medium. They moved up mid-market, stopped building for mid-market, and then moved to enterprise. Enterprise has been their core. And as they started dominating part of their enterprise market, they've slowly started coming back down to self-serve, small and medium, and mid-market, where they haven't really built a lot of product for, I'd say, 2 years. And so, when you go example by example, there's just a lot of nuances of what you need to do in order to grow at a certain pace and what's healthy growth versus just, throwing dollars at the problem without any yield.
Great. I have a question for you on that just in a minute here. But before we do that, we didn't talk too much about growth accounting, right, or growth itself. And there were 2 metrics that caught my attention that I would love for you to explain to our listeners. One is CMGR, right? Often people will focus on month-on-month growth, and I'll let you describe what CMGR is and CMGR V6 and so forth. And the other one is this notion of quick ratio, which also I think probably somewhat inspired by the financial statements. Can you talk about what those metrics are and maybe some examples of what they mean?
Yeah, and I think one more to add, just in the context of quick ratio, is the net churn. And we'll talk about it when we get there. But CMGR is the compound monthly growth rate. And what that is over some time horizon. Let's say you're measuring revenue, let's say you're measuring views per views or whatever you're measuring. It's what you would basically do is take 3 months ago, how many did you get in a month? Take today, how many did you get in a month? And then say if it grew at the same rate every month, how fast would it be growing every month? You'd look at different horizons. For example, CMGR3 is the 3-month horizon, is pretty recent. It tells me what's happening recently. But maybe there's noise, maybe there's seasonality, maybe who knows what is in there that's kind of messing it up. So you might look at a longer horizon too. You look at the CMGR 12. That's a good one that controls for annual seasonality. That would then tell you the average growth rate over every month for the last year. The reason why they're good to look at it in terms of the CMGR is because it actually gives you a way of comparing. Those numbers are going to be pretty close to each other. Versus if you said, how much did I grow? Let's say I grew 50% in 3 months and I grew 240% in 12 months. It's kind of hard to know exactly what's happening. And then one more thing is you can sometimes see things like acceleration when you have sustained high CMGR3 as compared to the CMGR 12. And I guess you can even imagine others. But that's on the compound monthly growth rate.
I want to interject you for a second here. Growth is often a function of marketing dollars and access to capital, right? So what if I just said, hey, I'm going to go pitch, Jake and Arjun at Tribe Capital. So I'm going to pump up marketing for the next 3-4 months. This is a little bit facetious, right? So how do you kind of figure that out, right? Or it could even be a genuine case where you're running out of capital. And so things were going great, but now CMGR is falling because cash in bank is not looking all that great. Yeah,
100%. I think very tied to CMGR are the concepts of retention and marketing. And I think this actually comes now, this is kind of more to the quick ratio, right? And I don't actually want to talk about the quick ratio too much because the quick ratio is a very useful SaaS metric. But the problem with the quick ratio when you have businesses that have large month-to-month variation is it will actually artificially depress the quick ratio. So the net retention, the net churn will actually tell you if you know the growth rate, for example, let's say you're observing 12% growth, 9% is from new users, right? You know from growth accounting. Then you know that 3% of growth is from net expansion, from negative net churn. So that is kind of one indicator of, okay, well, are these customers, if net churn is low or negative, then if I'm pumping money into acquiring these users, well, maybe it's a great thing because over time they're going to pay back. But even more important is something that we didn't talk about yet, but it's the unit economics. So when I put dollars in, what is the life cycle of that dollar? When do I get it back? So it's this concept of what does it cost to acquire? What is the LTV over time? And it could be sublinear, linear, superlinear, and so on. You can model it. And then what's the gross margin? And so those things together will tell you basically the life cycle of your dollar. And when you're out of kind of the single customer J curve. So these are all things that matter. And especially, we always look at acquisition. And so the thing you're talking about is very important. How does acquisition run? And a great experiment running tons of acquisition would be awesome because then we could dig into it and understand what would happen. We pumped a bunch of money in, right?
Understood. So are there any kind of good benchmarks that one could use, right? Because I'm like a 2% startup or 5% startup. I got some of this data. I got inspired by this podcast. But now how do I know, am I doing well or not? Any thoughts on that, on any of these metrics, not just on the churn or whatever?
So I think, that's tricky. I think there isn't a way of necessarily saying we can see the future, we know it's going well. And I think that even when you see good metrics, you always have to keep that in mind because especially when you're thinking, I'm going to grow 2, 3, 5, maybe 10x in a year, I'm going to be a totally different business when that happens. And or sometimes, and the whole world might change by then. And so it's very tricky to say this is going well or this is not going well. And you've always got to be really deep in it and really understand what's happening. And all of these metrics will just give you proxies. And it's really the higher level strategy, product execution, and hiring a great team, and all these other things about running a business that are going to really matter. I think that you can kind of get a temperature. It's almost like going to the doctor and getting a tiny, maybe some opinion of, maybe your throat's sore because you not drink enough water, but maybe it's something else. And you've always got to keep that in mind.
I think you guys had mentioned earlier and during the course of this show here that you can use this for way more than revenue, right? On engagement, on other metrics. So where does it stop, right? And where is it most effective? Clearly, it's very good for revenue. Clearly, it's probably good for retention and some of that. Can you talk about the scope of what you can use this for?
Yeah, I think the answer is technically anything, but things that matter, things that are indicative of product engagement and value. How do you know that you're delivering value? So there are cases where there aren't revenue. The consumer, maybe a free consumer platform, a social media platform or something, you'd probably measure things like number of days active in a month, or you'd probably measure things like, number of posts or number of friends or things like that. What is the value you're delivering? And that's really what you want to measure. And I think even better than revenue, and when you have a meaningful engagement metric, if you're talking about a payments business, for example, how much total payment volume are you processing? If you can understand the leading indicators of revenue, which are typically engagement metrics, then you can start to understand if there's deeper product market fit than is being priced for. Then you can start to see that a product might actually be in the position to price higher or go into, maybe go into segments that are a little less lucrative than the early adopter. I think that those are really the things you should be looking for. What are the value indicators, and which ones are potentially leading indicators of revenue? And that's really what I think you'd want to measure.
It's also leading indicators of churn, right? And that's why we think about engagement, because engagement can be defined in many different ways, right? If you're an API business or a transactional business that's just it's a request from your customers, those are not SaaS businesses. So you have to look at it very differently. Do you care if they come back every month? You may not, right? Like you want to make sure that there's a certain amount of frequency from your total base and how they use it. And so defining engagement is really important, because that's a part of demand. And that is going to be your leading indicator of where you think you may be able to price, charge, or understand what your revenue metrics are going to look like. And I think that's really important. A lot of companies that we've seen, they'll have some amazing revenue metrics. They'll come back and say, hey, we're at like 4 million in revenue or annual recurring revenue. And then we'll take a look at it, and then we'll use these same family of concepts to understand engagement, and no one's using the product. And so you can basically underwrite risk by understanding and saying, hey, do I think people are going to use this product and software more or not? And if the answer is you don't think they will, then you can, pretty damn well sure that they're going to churn out, and that 4 million will start looking like a depressed number 2 to 3 years later, depending on the contract. And I think that's really important. And so, where this really comes into play for us is anything that's software enabled or software engaged, where we can measure and understand what engagement looks like for customers and consumers, folks in the middle that are part of the transaction, and any business that is communicating with software today.
Wonderful, guys. So from Mad Men to Moneyball, that's the big takeaway. Lots of insights. For our listeners here, we will put the links to the Tribe Capital site, the 8-Ball metrics, and any other sources. So thanks again to Jake and Arjun for being on the show.
Thank you very much.
Thanks for having us, Matt.
Dear listeners, thank you for listening to this episode of the podcast. Subscribe now on your favorite podcast app for free, and you'll be the first one to know when new episodes are available. Just search for Prime Venture Partners Podcast in Apple Podcast, Spotify, Castbox, or however you get your podcasts. Then hit subscribe. And if you have enjoyed the show, we would be really grateful if you leave us a review on Apple Podcast. To read the full transcript, find the link in the show notes.